And I would like to start with a vision. You will excuse my personal interest in showing this slide to you, but this is the new campus of Bocconi University in Milano. And as I'm the one who chose the architects that put in place this beautiful stuff, I just want to start with just sharing this first slide. Sasha, thank you for your question, because what I think is that we're just facing a situation that is completely unknown. It is something that we have never experienced before. Let me start with this slide that is, to me, kind of astonishing. My sources are all official, and they are highlighted in my slides. This is the Federal Reserve Economic Department, and it shows that 37%, more than 1/3 of total dollars that are in circulation right now, were printed in 2020. This means that the liquidity that was generated by the United States, and by the way, exactly the same thing happened in Europe, same thing in Japan, same thing in UK. I mean, all the most important countries worldwide, all the most important central banks operated the same way. And this is the result of their activity. Liquidity, liquidity, liquidity. This is something that we must be aware of. Together with liquidity, what I think is that another important aspect must be highlighted, is to understand what the global scenario is offering us. The other word that I would like to use is debt. Let us take a look at the debt, again, of the United States. I mean, I'm not a fan of the United States in general. I'm using that example just because it is kind of reflecting something that is happening in the world, but with a gigantic situation, with a gigantic vision, typical for United States. This is the debt of the US government. And it's astonishing, because if you take a look at 1970, which is in the scale that I used on the x-axis, it is more or less midway between the two periods that are highlighted at the beginning and at the end. In 1970, it was nothing. Right now, it's close to 30 trillion US dollars. 30 trillion is something that is even difficult to pronunciate. It's a number of zeros after 3, which is astonishing. So that's the amount of debt that characterizes the US government. Things are not different if we take a look at the global system. In this graph, I put together basically the ratio. Let us just take a look at the top line in black. It shows the relationship between the total financial resources out there and the GDP of the world. And as you can see, starting from the beginning of the new century up to 2020, 2021, there is a dramatic increase in the relationship between financial markets, financial instruments, and GDP. So the financial economy is developing faster than the real economy, which is not necessarily good news. This chart is just shocking to me. This is the debt that characterized, and it's, by the way, it's sub-investment grade. I mean, risky debt. Sub-investment grade means, as you all know, below BBB- rating. And in 2007, let us forget about the units that are used here. In 2007, which is the year before 2008, the year when Lehman Brothers went bankrupt, and we know what the impact was for the global system, the total indebtedness of the system was 2. In 2020, also unfortunately thanks to the global pandemic, it was almost 6. So it tripled in less than 15 years. Another source of concern. Let me clarify one aspect at this point. I am not pessimistic. I am not concerned about the near future. What I am just highlighting is that we are facing something that is completely new, that doesn't characterize the behavior of financial markets, international financial markets. did not do that in the past. So this is the only thing that I want to highlight. Interestingly enough, and I'm happy that Mr. Governor is here with us today, what I think is that lessons learned from the past by the regulators, at least in the United States, are probably not enough. This is the Silicon Valley Bank situation in the third quarter of 2022. And as you can easily see, on the top right side of my slide, Silicon Valley Bank was characterized by mainly two features. They are investing long-term, and they are raising funds short-term. Basically, there is a clear unbalance, there is a clear mismatching between where they raise resources and where they invest resources. This is the reason why Lehman Brothers went bankrupt. The US authorities are not following Silicon Valley Bank because they consider it too small. We're talking about probably, in terms of total assets under management, about a bank that would be the fifth in the European situation, so a big bank. And having said that, again, the regulators were not probably as strong in terms of attention as they should have, because this is the fourth quarter 2022, so before, again, Silicon Valley Bank went bust. And as you can see, the adjusted for unrealized losses Common Equity Tier 1 capital ratio was 0. So they did not have any capital as of the end of 2022. So basically, a lot of liquidity, a lot of debt, regulators not necessarily with strong attention that is needed, that is required for putting in place a solid strategy for the with a long-term perspective. This is something that we should be aware of.
Thank you so much, but may I pose a question? Actually, it's a sub-question because it's regarding your sub-investment rate slide you just showed to the audience.
Yes.
It reminds me on a sub-prime mortgage market. This is the same experience with sub-quality. And this is a tricky play regarding the future of financial markets, making more risk to arise in the future. So how do you connect those two scenarios, like subprime mortgage market and past experience with the global financial crisis, and also with that sub-investment grade of the rates actually you mentioned?
Sasha, thank you. It's a very important question. The thing is, with the subprime crisis, 2006, 5, 6, 7, and 8, and then bust, the problem was that the financial markets were lacking investments. And, you know, investment banks, what they did was just to reduce the quality and increase the quantity of instruments. Here, situation is very similar right now. The difference is that all these huge avalanches of financial products are related with the fact that investors were looking and are still looking for yields. And when interest rates are equal to 0 or below 0, the only alternative that you have to generate yields is to go and invest in sub-investment grade assets. And that is the reason why the market was invaded by sub-investment grade bonds.
Yeah. And if I may, one more sub-question regarding the role of central banks. From the traditional theory, we know that central banks are the lenders of last resort. But from this perspective and the changing role of central banks globally, are they global savers of last resort than lenders in the context of big players not too big to fail and trying to save that kind of institution which are big players on the financial markets? How do you perceive that role of central banks in that changing circumstances? Sorry.
Sasha, let me say that without the intervention of central banks, what I think is that the global economy wouldn't be at the point where we are now. Probably would have faced something which would have been definitely a more severe and with a higher impact than the Lehman Brothers crisis. So, having said that, let me go back to the good old days. Banks could get money from deposits, from issuing bonds, from, of course, the inner bank sector, and from central banks. Now, investors are skeptical about bonds issued by banks. I'm not talking about Montenegro, luckily enough, but I'm talking about US, EU, Japan. So the bond sector, the bond context is complicated. Inner bank sector doesn't exist anymore. I mean, the banks are scared about the banks. So they don't want to lend money to other banks. So central banks are becoming, have become, and will be in the future key players, and not only as a last resort, but as a normal operator for funding the banks and maintaining the equilibrium of the system. I understand that also Mato pointed out a couple of times the need to fully take into consideration the risk profile when designing an industrial strategy or portfolio strategy. I'm happy that Claudia will be talking about that afterwards, and thanks to Raiffeisen Bank as well for the vision that they are going to share with us. Risk. This is something that excites me from a certain standpoint, because let me go here and let me show you something that not necessarily is known to everybody. If you take a look at the right-hand part of my slide, you can see that in 2005, the top 8 in terms of market capitalization corporations worldwide were characterized basically by 2 features. Feature number 1, they belong to a number of different sectors. The colors represent sectors. So we have General Electric, diversified entity, ExxonMobil and BP, and Royal Dutch Shell, oil and gas, Microsoft, technological company, Citigroup. I mean, a number of different entities belonging to different sectors. 2020, 2021, 2022 or 3, same story. And you can see that they all belong, the top 8 in terms of market capitalization, they all belong to a single sector, the technological sector, apart from Saudi Aramco, which is an exception. So 7 out of 8 corporations are concentrated in the technological sector. And in terms of dimensions, they are 6 times bigger in terms, again, of market capitalization than they used to be in 2005. So there is a strong concentration that is redoubled, because on one side, we're talking about a single sector. On the other side, we're talking about something that is 6 times bigger than it used to be in the past. So strong concentration in a single sector. I mean, I'm not saying that the technological sector is not offering super performances and excellent perspective for the future. What I am saying is that probably investors are too attracted by it, and the expectations that they have not necessarily will be met. Let me take one case, which is Tesla. This is an interesting couple of slides that I want to share with this audience. The market capitalization of Tesla, of course, it varies over time. These are the forecasts that was performed by Albert Bridge on Bloomberg as source for 2023. And as you can see, the market capitalization of Tesla is more or less equivalent to the sum of the top 7 car manufacturers worldwide. So you have Toyota, you have Volkswagen, you have Mercedes-Benz, you have General Motors. Okay, so market capitalization of Tesla, almost similar to all the most important groups and values. What is the capability of generating cash flows from Tesla? What is capability of meeting the expectations right now, not in the future, right now? This is it. So this is the capability of Tesla of generating cash flows. This is EBITDA, so potential cash flow, and cash flow that is currently expected, actually, being generated in 2023 by the top car manufacturers worldwide. There is a clear gap between expectations and reality, between what the market does in terms of behavior and what the real facts are in terms of cash flow generation. I took this from Bloomberg end of May, and this is a list of technological corporations listed worldwide. Of course, NASDAQ is the most important player here. And one of the columns highlighted here shows the ratio between the market capitalization price and the sales that are annually generated by these entities. And this is interesting because the top title is NVIDIA. We all know that it's a super technological company, and it is worth almost 40 times its sales. And it is paid more or less, and the data that I'm mentioning is taken from yesterday, it is paid more than 280 times the expected profits. So you pay 300 times the profits expected, and you pay something that is worth almost 40 times the sales. Expectations are good. We all have expectations. When we marry, when we have children, we all have expectations. Now, expectations must be met. And let me finish, Sasha, with this graph. This graph is interesting because it shows the book value of the most important worldwide corporations, the book value of these corporations in terms of equity, the red graph. The expected profits in the incoming 3 years, the blue part of the graph. If you put them together, the current value of equity plus the current value of the expected incoming 3 years in terms of profits, and then you have their market capitalization. The yellow area is expectations, expectations, expectations. Is the author of the graph, he called them dreams, hopes and dreams. This is something that we should be aware of. We have expectations that not necessarily are going to be met. And, if I may say so, just looking back at the very basics of the economy, of the traditional economy, can be kind of a safe harbor for investors, because probably the technological sector has attracted too much the interest and the resources of investors worldwide.